You know, guys, it was about a week ago that I posted a video about the stock market, where we were at with jobless claims, with unemployment, GDP, a lot of information like that involving the economy, and I gave my opinion on where I thought the stock market was going, what you should be doing at a time like this. And with all the recent information that we've had come through us in the last week, which there's been an astronomical amount of information that we're all going to be going over in this video. But basically, I get a lot of questions like this. It's people like this in my comment section. I see a lot of people on my videos, on other finance channels, constantly asking similar question to this. I want to sell all of my stocks now. I'm scared that there's going to be another dip. Thoughts? So basically, I'm going to be going over the answer to this question. Should you be selling your stocks now? Should you be buying more? People that are scared about another dip, I'm going to be addressing that as well. We're also going to be going over the major news that was dropped yesterday. The Fed sees interest rates staying near zero through 2022 and GDP bouncing to 5% next year. We're going to be going over last week's huge beat on unemployment rate and on jobless claims numbers. We're going to be going over this week's jobless claims numbers that was just released. We're going to be going over basic money flow and how the money supply works. And then we're also going to be going over NASDAQ hitting over 10,000 and everybody's greed and optimism towards the market right now. And also, this is really, really interesting to see Robinhood traders cash in on the market comeback that billionaire investors missed. So it's really interesting to see retail investors taking advantage of the stock market gains ahead of billionaires. So we'll be going over all that in this video. We have a lot of information to go over. As usual, if you enjoy watching my content and you're interested in using M1 Finance, we just had our 14th referral this morning. Thank you guys so much for that. Use my referral link if you're interested in getting started there. Go ahead and use that referral link down there in the description. And we did just pass 500 subscribers on this channel, so thank you guys so much. You can see here the market just opened. If you want to see an update on my portfolio, stay to the end of the video. The market is very much in the red today, as you can see here on the research tab. S&P's down about 2.5%. So we'll be going over all this information. I'll be saving an update for my portfolio at the end. So go ahead and get started here. We have Fed sees interest rates staying near zero through 2022, GDP bouncing to 5% next year. Now, one thing I'm really excited about for this is that I graduate college in a little less than 2 years from now. In May of 2022 is when I'm intending on graduating college. Sometime after that date, within the next couple of months to a year, I plan on getting a house. So whether or not it's in 2022, 2023, it's going to be somewhere around that time. So just for my sake and the sake of buying a house, I hope that this stays through 2022 because I'd love to get a house for cheaper. I gave a video the other day talking about how 1% interest rate on a house for a 30-year mortgage makes tens of thousands of dollars in difference in interest. But in my opinion, keeping interest rates at zero is a little bit farther out than I expected, all the way to 2022 already. Now, I definitely expected that through 2020. I even predicted that it would stay most of through 2021, but I did not expect it to stay all the way through 2022. But they said that the GDP is intending on bouncing to 5% next year. The Federal Reserve voted Wednesday to keep benchmark short-term rates near zero. In addition to the rates move, the Fed said that it would keep buying bonds, targeting $80 billion a month in treasuries and $40 billion in mortgage-backed securities. On the economy, the Fed sees GDP tumbling 6.5% in 2020, but bouncing back to a 5% gain in 2021. So this is really when they talk about the V-shaped recovery. So whether or not this is going to happen, people are assuming that we're going to have a V-shaped recovery in the stock market. They're going to have a V-shaped recovery in the economy. You can see here the NASDAQ is the perfect example, which we'll go over that in a minute. If there's any example of a V-shaped recovery, the NASDAQ is it. Man, you talk about a straight line down and then pretty much just up and up and up every single day. Non-stop, day after day, in the green. So we'll see if the economy follows suit. We did just have a recent job gain last week, and that is the next point that we're going to be going over. They were expecting a fall in jobs last week, but we actually had 2.5 million job gain. So a massive gain in the stock market. Not only did we not lose job, which that's already a win in my opinion, but we had a massive gain. 2.5 million is no small feat. That is an amazing number to put up, and that makes me so excited and so happy about the future, and not so much for the stock market. That's just the secondary. That's just the benefit that's going to come along with it. But why I'm so excited for that is that I have been really worried. I have been really upset about millions of people that have been losing their jobs, people that can't feed their family. So 2.5 million back to work definitely makes a difference. And unemployment rate falls to 13.3% as economy gains 2.5 million jobs despite coronavirus. The U.S. economy gained 2.5 million jobs in May, and the unemployment rate dropped 13.3%. That's down from 14.7% in April, according to the monthly employment report released Friday by the Bureau of Labor Statistics. I always like to mention Donald Trump's tweet. So, tweeting 3 minutes after the release, really big jobs report, great going, President Trump. Kidding, but true. So, regardless of whether you support Trump or not, it's good to see all the work that's being done by our government, getting jobs back into the workforce. So, obviously, this comes back from people getting back to work, those that lost their jobs or were furloughed from their jobs just for a couple months. But with those people getting back into the workforce, we're going to give a basic breakdown on how the economy works for those of you that don't know. So, with more people employed, that means more people getting paid. So as more people get their jobs, and when they get those paychecks, that means more money being spent. Now, it doesn't matter where they spend that money. It doesn't matter if they spend it at McDonald's. It doesn't matter if they buy the new Apple iPhone. It doesn't matter if they pay their bills and then save the rest. That means more money flow is getting back into the economy, so that means more money being spent. When they spend that money, that means more money is going back towards the businesses. So like if they go to Walmart, if they go to spend $20 on groceries, that's $20 that Walmart has on their balance sheet. They're going to then use that money, the businesses will, and they will hire more people and expand and do more development and do anything that will create more jobs. And then it just goes right back to the circle. It just goes right back to more people getting employed. So it's just a trickle down effect, and then it goes right back to the start and then trickles down. And it's basically just a big circle with money. The more times it exchanges hands, the better for our economy. And so this is really good to see with more people getting employed, and I love to see this information about the economy. But this weekly jobless claims just came out and the numbers just came in, and it said that weekly unemployment claims better than expected as workers leave jobless roles. So unemployment claims totaled 1.5 million last week compared with a 1.6 Dow Jones estimate and 355,000 fewer than the previous week. Continuing claims or those collecting benefits for at least 2 weeks declined to 20.9 million, 339,000 fewer than the previous week. The total claims number has fallen for 10 straight weeks but remains extremely high on a historical basis. So at this point, when you see the dramatic, insanely high numbers with 44.2 million to jobless claims, that doesn't tell the whole story now, because we're at the point now where even though 1, 2, 3 million are getting jobless claims every single week, you have more than that returning back to the economy. So next month when we see the unemployment numbers and the number of job growth that we see, I think we'll see a pretty big number in the next month as well, more than 2.5 million. So that is really good to see. And even though it is dramatically high, and it's even crazy to even compare this at 2 million, because it's like 10 times higher than what we had seen previously, it is still good to see that that number is falling for jobless claims. So you know that job growth right now has to be massive. So I'm sure that 5% GDP number that the Fed put out is pretty close to an estimate to where we will probably be in the next year or so. One thing that I forgot to mention that is not included in this article, I was watching Jerome Powell speak about the Fed at 1:30 when he was having his meeting answering a bunch of questions about the economy and Fed's balance sheet and anything involving the US. But one thing that he pointed out is that he expected to see inflation right around 2% with the interest rates at 0%. A lot of worry about the economy and about the stock market in general with recent stimulus checks being passed, with trillions worth of bonds being bought, billions of dollars worth of stimulus programs, with all this money being flowed back into the economy. One of the main issues that has been worried here is hyperinflation. So one thing that is really important is that Jerome Powell said that he and the Fed sees about a 2% rise in inflation, which is right around target to where they need to be. Anything that is 5, 10, 15, 20% or anything crazy higher than that can be very, very, very dangerous to our economy. So seeing it at just 2% seems very healthy, and it makes me worry a lot less about whether hyperinflation would take effect. So I wouldn't really worry so much about that. So in all this, we have to ask the big question. We have unemployment still at record highs, but it is starting to drop. We have people getting back to their jobs. We have stimulus checks being passed. We have all these other issues taking place. What is happening to the stock market? Well, NASDAQ hits 10,000 for the first time ever, closes at record highs as Apple and Amazon soar. So you can see this is the one thing that I don't like. I feel like it's getting to the point now where there's more and more optimism about the market. You have people like Jason Lynn here who are scared. Do they think there's going to be another dip? But you have a lot of people now that they're completely flipping the script. You had in March where everybody was going, oh my gosh, the stock market is dropping so hard. Everybody sell out now. It is getting so bearish. This is going to get so much worse. And now it's getting to the point now, you see it rises and rises. And now we're at an all-time high for the NASDAQ. And people are getting to the point now where they think it's never going to stop, where they're getting too optimistic. Talking about the fear and greed index, people get extremely full of fear and then sell at rock bottom, and then they get FOMO, fear of missing out, and they see it hit all-time highs, and they go, oh my gosh, we got to bow back in, it's never going to stop. People get too optimistic. So people get too bullish, and then that's when people get hurt. People see happy pictures like this in the news. They see awesome articles with catchy head titles, and they see great pictures of people in the trading forum with smiles and thumbs up. You can see people smiling here. Everybody's happy, but that's not reality. It's not going to last forever. You can see right here, for example, this number right here. Dow's down 2.78% as I speak. Just know this is why you should buy into the market thinking about the long term. Because when you see here, when you buy into this point, when you buy in March lows, you know that eventually you're going to be up. It may take a week, it may take 5 years. And you know that eventually when you buy here, when you buy at $235 a share, when you're buying at all-time highs, you know that eventually you're going to be up. It drops, and then eventually you're going to go back to an all-time high. How long that takes is debatable, but basically you should know that you should focus on the long term and especially focus on the dividends because those are a lot more predictable than any short-term market move will ever be. So one reason why the Nasdaq is at all-time highs and the S&P and the Dow is not, as you can see here, the S&P, we'll look at the 5-year chart. You can see it's not quite to an all-time high yet. It's still got a little ways to go, but it's not all the way there yet. We look at DAI, the Spider ETF for the Dow Jones. You can see it's not at an all-time high either. It's also still got a little ways to go. So the QQQ, or the Nasdaq ETF, why is that at an all-time high? Well, a lot of the weight comes from a few big names, mostly tech companies. You have Microsoft, you have Apple, and let's see how they're doing. These are two companies that I own. All-time highs, just hit $193 today. It almost hit 200 yesterday. And we see Apple. Apple has been on a tear the last couple of days. Apple has pretty much been in a straight line up, and Apple is now a $1.5 trillion company. I remember when it was breaking above around 250, 300, and people were talking about, wow, it finally hit the $1 trillion club. It was the first company to ever hit $1 trillion in value. And now we're over 50% higher than that. $1.5 trillion company. That is absolutely insane. You can see the performance over the last 5 years. This company has just went in a straight line up, especially the last week. On the month, it's up 12%. 3 months, 28, and on 6 months, 30. You can see the year chart, it's almost doubled. It's up 81%. Investing in these giant tech companies has definitely performed very well, and we see a lot of other tech giants like Facebook, all-time highs. We see companies like Amazon, these giants, $1.3 trillion market cap, all-time highs, hitting record numbers. It is a $2,600 stock. And before I go any further, this is not included in the NASDAQ, but one thing I'd like to point out, big shout out to Tesla. It just broke below 1,000 just now because we're a down day on the market, but Tesla finally broke $1,000 per share in the stock market. Shout out to Tesla. That is absolutely amazing. Even breaking past those huge highs in the beginning of 2020. So that is awesome for Tesla. Anybody that was buying Tesla in these $300-$400 range, you know you're sitting pretty right now with probably triple, double your investment from what you started with. So hats off to Tesla. I'm sure eventually I'll probably get into this company one day. I just can't wrap around getting behind no dividend on this company. But I absolutely love this company, so that is so great to see it finally break above $1,000. So we're going to get to the last article here, and then I'll answer Jason Lynn's comment, and then answer generally should people be buying into the market or selling out of the market right now. So Robinhood traders cash in on market comeback that billionaire investors missed. Retail investors capitalized on the market comeback unlike the billionaire hedge fund managers who said stocks would retest their lows. Billionaire favorite stock trading app Robinhood saw new investors piling into stay-at-home stocks, and those most beaten down by the economic shutdown like airlines, casinos, and hotels. One 26-year-old trader made $1,500 in less than 24 hours betting on a beaten-down airline stock, while many so-called experts on Wall Street warned about buying into overvalued stock market that was bound to tumble again amid the coronavirus pandemic. So this goes to show you've seen a lot of people betting on the stock market with their stimulus checks. You know, you see stories on like stuff like Wall Street Bets. People taking their $1,200 stimulus check and just betting on a crazy option play. Sometimes they'll 10 times their money. Sometimes they'll take it to zero in a couple of hours. But it's crazy to watch that. But it just goes to show that nobody knows where the market is going. It doesn't matter if we're talking about me, you watching my channel, you as a viewer, big hedge fund managers, Warren Buffett. Nobody knows where the market's going to go. If you would have told me back in March of 2020, if you would have told me on March 23rd, you would have said, okay, the Nasdaq's going to be at all-time highs in just a matter of about 2-3 months. I would have went, you're crazy. That's not going to happen. It might rise a little bit. We might recover, but it's not going to all-time highs. I think it happened to a lot of people as well when we started to see a lot of rise in the market for coming weeks. We got to April, and a lot of people were saying, okay, we're going to see another downturn. Me personally, I expected another downturn, and that just shows that nobody can predict what's coming along. You have no idea what's going to happen. Quit trying to predict the market and just buy in. So if you're Jason Lynn, for example, if you're asking me, you think there's going to be a dip, you're considering selling out. My question to you is, if you would have been in March, if you would have saw the huge dip in the stock market and you would have sold out, don't you think you would have missed out on a lot of gains? So the same thing goes here. You see we're at an all-time high. I understand it's easy to want to sell out. You might be thinking, okay, we're going to see another dip, and we very may well see that happen, but it might not. So what if you sell out here and you see it's $240 a share, and what if the NASDAQ goes to 260? What if it goes to 280, 300? What then? You're going to miss out on gains, and then what are you going to do? You're going to buy back in 10, 20, 30, 40% higher than what you were at? I doubt that's going to happen, and you're probably going to miss out on a lot of gains. Another thing, what if you buy back in and then it drops further? Let's say you see here, this is S&P, it's 311. Let's say you see a dip here, and let's say it goes to 250. And then you buy back in, and then it drops all the way to 150. Let's say we have a massive drop past that. Do you sell out? Do you say, oh, okay, it's going to keep on dropping? You can't time the market, is what I'm trying to get at. If you're scared about a drop, what I would recommend, I can give you a few bond ETFs. If you see here, we're going to go to research. Let's hit funds. Here, I'll just get rid of this. I'll pull up. If you're on M1 Finance, you click bonds, you click domestic, then you click government, and then you click long term. In any one of these 8, specifically VGLT, EDV, and TLT are the 3 that I'd recommend. You go to those, and these are long-term Treasury bond ETFs. You see the long-term performance here. When the market crashed, these absolutely soared. These are long-term Treasury bonds. If we see another crash in the market, these are going to skyrocket, and that will protect your portfolio against a massive drop in the market. So if you want to move 10, 20, 30, 40% of your portfolio into these bonds, that can protect you against a market crash. So that way, it's a win-win. If the market crashes, then your stocks are going to go up in the bond portfolio, and you're going to be pretty much about break even, and then you can just buy in with those gains that you had from the bonds when you sell out of them. And if you're wrong, if the market goes up, then you still get dividends in the form of interest from these long-term treasury bonds. So just buy into the market, just quit worrying about timing the market, and just focus on the long term. That's my opinion to anyone. You're welcome to do whatever you want. Anybody who has questions about the market, make sure to leave me down in a comment below. But that's pretty much it, guys. That's my opinion on the market. I think in the long term, we're still going to be fine. I'm not going to predict anything in the short term. We have a lot of good economic data, and as I like to mention at the end of all of my videos, if you're interested in using M1 Finance and you would like to see more of my content, go ahead and click this successful referral link, and you can get started with your dividend portfolio, and you can get $10 started there. But just a very quick update on my portfolio. We have done very good so far in the portfolio. We are at all-time highs yesterday at about $2,600 we hit on the portfolio. A lot of my big names still doing very well. Discover has went down quite a bit. We were over 100% on it. We're still up on everything except Starbucks. Starbucks had a very rough day yesterday, but overall we're doing very good in the portfolio. You can see some of my big names here. The recent activity that I've had in my portfolio, we did just do some more buys yesterday. We did afternoon trading of about 13 different companies. You can see the list right here if you're interested. And I did just receive one more dividend yesterday from International Business Machines for 97 cents. So overall now I've deposited, I think it's $2,025 to the portfolio, and we are now up to $2,520. And you can see here in total we are up 21.32%, 377 in total gains, 362 from market gain, and $15.44 from earned dividends. So thank you guys so much for watching all the way to the end. Leave a comment down below what you think about the market, if I'm wrong, if I'm right, if you're taking any kind of new strategies with NASDAQ hitting all-time highs and these tech companies hitting massive market caps. So let me know down in the comment section below what you think about that, and I'll catch you guys next time.